What if I told you there's a Singapore-listed company, a company most retail investors have never heard of, that just became an officially approved vendor for Nvidia? Not one of the big names. Not Venture Corp, not Frencken. A small-cap manufacturer sitting quietly on the SGX with a market cap of about 183 million Singapore dollars. Their stock went from 34 cents to 71 cents in less than 12 months. And the story is just getting started. Welcome back to JC Project Freedom. And today we're going deep on InnoTek Limited, SGX ticker M14. This is not a stock tip. This is institutional quality analysis brought down to earth. By the end of this video, you'll understand exactly what InnoTek does, why the Nvidia catalyst matters, what the numbers actually say, and whether, at today's price, there's still a margin of safety left. Let's go. First things first. What does InnoTek actually do? The simple version: they are a contract precision manufacturer. Big companies, the ones you know, design their products, but they outsource the actual metal fabrication to companies like InnoTek. Think about the office printer you use at work. Inside that machine is a chassis, a frame, dozens of stamped metal brackets. InnoTek made those. Think about an AI server rack, the kind Nvidia's GPU chips sit inside to power ChatGPT and all these AI models. The precision-machined aluminum frame, InnoTek again. Or think about an EV battery pack from CATL. The structural frame holding the battery cells, possibly InnoTek. They are the factory behind the factory. They run two main business units. Precision mechanical manufacturing, that's high-volume metal stamping, where they feed sheet metal into massive presses and punch it into shape. And precision intelligent manufacturing, that's CNC machining of aluminium, the more complex, higher-value process. They operate across 3 countries, China, Thailand, and Malaysia. About 3,500 people work for them across 5 plants. Now, let's look at where the money actually comes from. In FY 2025, InnoTek did 210 million Singapore dollars in revenue. Here's the split. Office automation, printers and copiers, that's the biggest piece, about 39% of revenue. Mature business, but stable. Their customers here are in the Japanese OEM ecosystem. Think Ricoh and Canon supply chains. Automotive is next, about 22%. But this is under pressure. U.S. tariffs on Chinese-made goods have been hammering volumes. And then, this is the one I want to pay attention to, AI server. That's 21% of revenue now, at $43 million. And it grew 21% in FY 2025. TV and display is declining intentionally, about 13% and shrinking. New energy, that's EV batteries and energy storage, just 5%, but it's early-stage growth. Here's the framing I want to give you. InnoTek is a company mid-transition. The old segments, automotive and TV, are under structural pressure. The new segments, AI server and new energy, are growing fast but still small. The investment thesis is really a bet on whether that transition happens fast enough. October 2025. This is when everything changed for InnoTek. The company announced it had been approved as a recommended vendor for Nvidia, the world's dominant GPU manufacturer. And simultaneously, they were approved by IIT Systems, which is part of Inspur, China's largest server manufacturer. Let me explain why this is significant. Nvidia doesn't just let any factory supply parts for their GPU server ecosystem. Their supply chain qualification process is one of the most rigorous in the world. InnoTek spent 2 full years, building capabilities specifically to earn this status. And it worked. By the 4th quarter of FY 2025, they had already commenced mass production of GPU rack and server components. These are the physical structural frames and housings that house Nvidia's chips in data centers around the world. Management has said they expect Nvidia, through its ODM partners like Foxconn and Wistron, to become a top 10 customer in the coming years. That's extraordinary for a $183 million company. This is not a press release. This is actual production, actual shipments, actual revenue. Now, let's look at the numbers honestly. Revenue grew steadily from $187 million in FY 2022 to a peak of $238 million in FY 2024. Then FY 2025 hit, and revenue fell 11.8% back to $210 million. Gross margins, peak of 16% in FY 2023, dropped to 13.6% by FY 2025. Net profit, down 65%. EPS just 0.87 Singapore cents. But here's what I find remarkable. Through all of that, InnoTek paid their dividend, 2 Singapore cents per share for the 10th consecutive year. Now, I'll be real with you. The dividend was paid from cash reserves in FY 2025, not from free cash flow. That's a yellow flag I'll come back to. But it signals management's conviction that this is a trough, not a collapse. 10 consecutive profitable years. That's not nothing. Most small-cap manufacturers would have gone into survival mode. InnoTek kept paying their shareholders. The question, and this is a question the whole thesis hinges on, is whether FY 2025 was a cyclical trough or the beginning of structural decline. I believe it's a trough. Here's why. So what actually caused the earnings to drop 65% for things? All of them explainable. First, U.S. tariffs. The tariffs on Chinese-made goods have been brutal for InnoTek's automotive segment. Their China factories make components for auto supply chains. And when those components become more expensive to import into the U.S., customers cut orders. Simple cause and effect. Second, TV and display. The global LCD TV market is in secular decline. This is a surprise, and InnoTek is intentionally exiting this segment. But exiting takes time, and the revenue decline hurts while you're doing it. Third, the Vietnam disposal. In October 2025, InnoTek sold its 70% stake in a Vietnamese subsidiary. This was a strategic choice to free up capital and simplify the business. The right call, but it removed about $15 million of revenue from the group. And fourth, and this is the manufacturing reality, when your volume drops, your fixed costs don't disappear. You still pay for your machines, your factory leases, your workforce. So margin compression can be savage even on a moderate revenue decline. None of these 4 factors are permanent. The tariff situation can change. The TV exit is complete. Vietnam is done, and volume can recover. That's the bull case. Management isn't just waiting for things to recover. They have a clear 3-pillar plan. Pillar 1, AI server and data centers. This is the flagship growth engine. They're ramping GPU rack components with Nvidia's ODMs and IIT systems. They're developing liquid cooling systems for next-generation servers. They're opening a U.S. office to develop direct relationships with hyperscalers, the Microsofts, Googles, and Amazons of the world. And they're actively building out their AI server product pipeline. Pillar 2, Southeast Asia expansion. This is a tariff neutrality play. They're constructing a massive 15,772 square meter factory extension in Rayong, Thailand. That's quadrupling their existing Thailand capacity. It's expected to start operations in the second quarter of 2026. They're also developing CNC machining capacity in Malaysia, specifically for U.S.-bound AI server orders. And they raised 16 million Singapore dollars in April 2026 to fund this. Pillar 3, New Energy. This is the optionality bet. They're expanding their relationship with CATL. That's the world's #1 EV battery manufacturer, supplying structural battery frames and module components. Small today, but potentially meaningful as the EV market grows. 3 pillars. 1 theme, escape China tariff exposure, capture AI infrastructure demand, build a tariff-neutral ASEAN supply chain. Let me show you exactly where InnoTek sits in the supply chain. At the top, raw material suppliers. Baosteel, POSCO, Novelis. They supply the steel coils and aluminum that InnoTek converts into components. Then InnoTek. They stamp and machine those raw materials into precision components. Below them, the server ODMs and system integrators. Foxconn, Wister, and Compal. These are the companies that actually assemble complete server systems. Then Nvidia and IIT Systems, who design the GPU architecture and brand the final products. And at the end of the chain, the hyperscalers. Microsoft Azure, Google, AWS, Meta AI. They buy the finished GPU servers to power their AI models. So InnoTek is a Tier 2 supplier in most of their markets. But, and this is a key insight with Nvidia vendor status, they're moving toward Tier 1.5. Nvidia's ODMs are required to consider InnoTek as a preferred supplier. That's a very different commercial position than most of their competitors. For a company with a market cap of $183 million, being in the Nvidia supply chain is genuinely rare air. Let's talk about the people running this company. Chairman Neil Chandaria owns about 29.7% of the company. He's from a Chandaria family, a well-known industrialist family with long roots in manufacturing businesses across Asia and Africa. He's a long-term steward, not a short-term trader. That's the kind of alignment I want to see. CEO Liu Ilyong is the operational architect of everything we've talked about: the AI server pivot, the Thailand expansion, the Nvidia relationship. He has 9.63% of the company. Skin in the game. There's one flag I want to be honest about. In April 2026, as part of the share placement, CEO Liu Ilyong sold 6.15 million of his own shares at 0.6506 Singapore dollars. That's the same price as the placement. He retained a moratorium on selling more for 6 months, and he still holds 9.63%. But selling shares, even partially, at near lows is a signal I always take note of and want an explanation for. On the governance side, 2 new independent directors were appointed in August 2025, including a new lead independent director chairing the audit committee. That's a governance upgrade, and it came right as a company is entering its most ambitious growth phase. The track record speaks for itself. 10 profitable years. Dividend paid every single year. The share price tells a fascinating story. In mid-2025, the stock was at 34 cents. That was the 52-week low. The market had written off InnoTek as a struggling contract manufacturer with declining earnings and tariff headwinds. Then October 2025 happened. The Nvidia vendor announcement. The stock started moving. By February 2026, when full-year results were released, despite showing a 65% profit decline, the stock had continued to climb because management maintained the dividend and the AI server story held. April 2026, the $16 million placement at 0.6506 Singapore dollars. Lion Global Investors, an OCBC subsidiary, participated as one of the places. That's institutional validation. Today, the stock sits at about 71 cents. The 52-week high is 0.785 Singapore dollars. Here's important context. The stock has essentially doubled from its lows, but earnings didn't double. In fact, earnings fell. What doubled was a valuation multiple. The market paying more for each dollar of InnoTek's earnings because of the AI server narrative. This means if the AI ramp doesn't deliver, there's real downside. The market has already priced in the bull case. You're not getting it for free. April 2026. InnoTek raised 16 million Singapore dollars through a private placement, issuing 24.6 million new shares at 0.6506 Singapore dollars each. That's a 10.5% expansion of the share count. Existing shareholders got diluted. Now, how do I read this? The positives, Lion Global Investors bought in. That's meaningful institutional validation. The capital is earmarked 91% for acquisitions, joint ventures, and strategic alliances in Southeast Asia. Management has a specific deployment plan, not just a general corporate purposes vague statement. But here are the watch items. The CEO sold alongside the company. If you believe so strongly in the AI story, why sell at near lows? I'm not alarmed. He kept 9.63% with a moratorium. But it's a question I want to ask management directly. The specific M&A target also hasn't been disclosed. That's standard practice. But investors need to monitor whether that 16 million Singapore dollars gets deployed wisely. Overall read, net positive with eyes open. Let me be direct with you about InnoTek's moat. It's narrow. This is not a wide moat business like Visa or Apple, but it's not moatless either. The most compelling moat element is the Nvidia vendor qualification. That took 2 years to earn. Nvidia's ODMs, Foxconn, Wistron, Compal, are required to consider InnoTek as a preferred supplier. A competitor wanted to displace InnoTek in that supply chain would have to go through the same rigorous qualification. That's a real barrier. The second moat is switching costs. When InnoTek stamping dies are qualified for a customer's product, switching to another supplier requires revalidating the production process. That creates commercial inertia. OEMs don't take supply disruption risk lightly. The weakness: InnoTek is not the lowest cost producer. Chinese competitors with cheaper labor exist. InnoTek wins on quality and relationships, not on being the cheapest. And with Japanese OA customers like Ricoh and Canon supply chains, InnoTek has multi-year relationships that generate genuine stickiness. These companies don't change their precision component suppliers every year. Narrow moat, deepening around the AI server position. That's my assessment. How does InnoTek compare to its peers? Looking at the table on screen, InnoTek at 71 cents is valued at about 0.82 times EV to sales. That's in line with contract manufacturing peers globally. The trailing P/E looks scary at 82 times. But here's the context. That's on Trough earnings of 0.87 cents per share. If you run a forward P/E using my FI 2027 base case earnings of about 2.83 cents per share, that P/E falls to around 25 times. Suddenly it's comparable to Frencken, which trades at about 22 times. Frencken is the closest SGX peer. Bigger, more diversified, better margins, semiconductor exposure. It is a better quality business at today's prices. I want to be honest about that. InnoTek needs to earn its premium through execution. The AI ramp needs to deliver. Margins need to recover. That's the work still ahead. But the dividend yield of 2.8% is real, and it gives you some return while you wait for thesis to play out. Here's the earnings model. Base case: I'm assuming AI server revenue grows 50% in FI 2026, from 43 million Singapore dollars to about 65 million Singapore dollars. Office automation stays roughly flat. Automotive declines modestly. Gross margin recovers from 13.6% toward 14.5% in FI 2026 and 15.5% by FI 2027 as the higher margin AI machining business grows. Under this scenario, EPS grows from 0.87 cents in FI 2025 to 1.36 cents in FI 2026, then 2.83 cents in FI 2027, and reaches 6.36 cents by FI 2030. Bear case: AI server ramp is delayed 12 months. Gross margin stays below 14%. EPS reaches only 0.50 cents in FI 2026 and 1.40 cents in FI 2027. The range is very wide. That's the honest reality of this investment. This is not a stable earnings, predictable dividend compounder. This is a transition story with a wide range of outcomes. If the base case plays out, this is a multi-bagger from here. If the bear case materializes, the stock could give back half its gains. Invest accordingly. Size it as the speculative position it is. I always look under the hood of the accounts, not because I expect fraud, but because the accounts often tell you things the press releases don't. Here's what I found in InnoTek's FI 2025 financials, audited by Ernst & Young with a clean opinion. First yellow flag: profits are being propped up by investment portfolio gains. InnoTek holds about 20 million Singapore dollars in listed equity securities managed by Bank of Singapore. In FI 2025, the core manufacturing business made an operating loss of $1.9 million. InnoTek only reached a positive profit before tax of $2.6 million because of $5.8 million of other income, which included investment fair value gains and interest income. Strip that out, and this is a loss-making business at the operating level. That's important context. Second yellow flag: the dividend was paid from cash reserves. Free cash flow in FI 2025 was approximately negative $0.6 million, meaning the $4.6 million dividend wasn't earned. It was paid by dipping into the bank balance. Short-term, sustainable. Long-term, earnings need to recover. Now here's what I did not find. No aggressive revenue recognition, no complex related party arrangements, no goodwill write-off risk, no hidden liabilities. The books are genuinely clean. 6 risks: Be honest about each one. Number 1. The AI server ramp is delayed. This is the highest severity risk. If Nvidia ODMs push out volume by 12 months, which happens regularly in tech supply chains, InnoTek's FY 2026 earnings disappoint, and the stock reprices lower. I put this at medium probability. Number 2. Gross margin stays depressed. If the manufacturing mix doesn't shift toward higher margin AI machining fast enough, margin recovery stalls. The stock thesis depends on margin recovery. Number 3. U.S. tariff escalation. Further tariffs on China-manufactured goods would increase pressure on InnoTek's automotive and OA customers who source from their China plants. Number 4. CEO or key management departure. Lu Iliang has been central to the AI pivot. His departure would be a material negative. Number 5. Dividend cut. If earnings don't recover, at some point the board may cut the dividend. That would trigger a re-rating. Number 6. Thailand capex overruns. New factories always carry execution risk. The two I worry about most: AI ramp timing and gross margin recovery. Everything else is manageable. Invest with your eyes on those two metrics. Now for the valuation. What is InnoTek actually worth? I use two methods and average them. Method 1. A Buffett-style owner earnings DCF. I anchored to normalized earnings in FI 2027. What InnoTek should look like if the AI ramp delivers, and discounted those back at 10%, which includes a risk premium for their China manufacturing exposure. My base case gives me a fair value of 1 Singapore dollar and 9 cents to 1 Singapore dollar and 19 cents per share. Method 2. EV to EBITDA multiples compared to sector peers. Using a 10x multiple on FI 2027 normalized EBITDA of around 22 million Singapore dollars, I get an equity value of approximately 95 cents per share. Blend those two, base case fair value of roughly 1 Singapore dollar to 1 Singapore dollar and 7 cents. Current price, 71 cents. Margin of safety, approximately 33 to 36%. That clears my 30% minimum threshold. Now let me flip it. Reverse DCF at 71 cents. Was the market pricing in? About 7 to 8 million Singapore dollars of normalized owner earnings, which means the market is already assuming AI server hits roughly 65 million Singapore dollars and gross margin recovers to 14.5%. In other words, the base case is already priced in. You're not getting it cheap. There's upside only if InnoTek delivers better than the base case. Before I give you the verdict, here are the 5 questions I'd want answered by management, and the 5 questions you should be tracking in every quarterly update. Question 1. What are the confirmed purchase order volumes from Nvidia ODMs for FI 2026? Not the pipeline, not the conversations, the actual orders. Question 2. Is the 2-cent dividend sustainable? And for how long can it hold if free cash flow stays negative? Question 3. What gross margin is the AI server business currently running at? This determines whether the mix shift thesis is actually playing out. Question 4. CEO Lu Iliang, why did you sell 6.15 million shares at near lows in April 2026? What was the personal rationale? And question 5. What specific acquisition or joint venture are you targeting with the $16 million placement proceeds? These 5 questions will tell you more about InnoTek's future than reading 200 pages of annual reports. Monitor the AGM transcripts, the 1H results briefing, and the investor presentation for answers to all 5. So, the verdict. Under the JC Fund framework, my personal investing framework, InnoTek is conditional. That means I initiate a half position at current levels around 71 cents. The margin of safety of 33 to 36% technically clears my 30% minimum. But I'm not going full position yet, because 4 of my 5 quality scorecard gates are failing at this earnings trough. The cash flow is weak, the gross margin is declining, and the dividend isn't covered by free cash flow. I upgrade to a full position when and only when the 1HFI 2026 results show AI server revenue on track to annualize above 60 million Singapore dollars, and gross margin has recovered above 14.5%. Those are concrete, measurable conditions. Not vibes, numbers. And I downgrade to avoid if AI server revenue is flat or declining in 1H 2026, or if the company cuts a dividend, or if gross margin falls below 13%. This is a speculative growth position, not a core holding, not a set and forget, an active monitoring story. And for me, personally, it fits my JC Project Freedom philosophy, finding asymmetric opportunities that the market hasn't fully priced in yet. Let's wrap it up. 5 takeaways from today's deep dive on InnoTek. 1. This is a contract manufacturer pivoting to AI, and they've earned Nvidia vendor status to prove it. That's rare for a $183 million company. 2. FY 2025 was a trough, not a collapse. The company maintained profitability and paid its dividend for the 10th year in a row. 3. The Nvidia recommended vendor status is a game changer. It took 2 years to earn, and it's hard to displace. That's the moat. 4. Base case fair value is $1 Singapore dollar to $1 Singapore dollar and 7 cents, a 33 to 36% margin of safety at today's price. 5. My verdict is conditional. Half position now. Full position when the AI server ramp confirms in the numbers. If you've made it this far, you're my kind of investor, the kind who does the homework instead of chasing hype. Drop your questions in the comments about InnoTek, about the JC Fund framework, about anything. I read every comment, and I try to reply to as many as I can. If this video helped you think more clearly about how to analyze a small cap stock, give it a like. It takes 2 seconds, and it helps more people find this content. And subscribe, because next up, I'm doing my full FI analysis. Am I financially independent yet in 2026? You won't want to miss that one. See you in the next video.